Hey guys, welcome back. Today we will be taking a look at options volume to see if we can extract some sort of sentiment using the volume of short dated options. In this tutorial, I'll be using my database to get options data, which I have been collecting from the CBOE and just appending my database on a daily basis. If you would like to start collecting this data, I have a script on my Patreon that will scrape this data. So long as you run this on a daily basis, you'll be able to build your own database. To start off the script, here are some of the packages we're going to require. And right below it, we have a function where I just pass in the ticker and I'll be able to extract the options data from my database given the parameters I set. So if we open up that function, I'll need to establish a connection to my SQLite database. Now all the parameters I've set are in this query, so all the calculations will be made by passing on this query instead of making the calculations in RStudio, and this will make the script run faster than me subsetting my options data in R. And in this query, I'm just returning the day and an average, which I'll go over in a bit, where I'm going to subset my database by date, and my average will be the volume multiplied by the mid, which is the options premium times 100. Now this will give me the dollar volume on average for all the options that traded that day. But since I have multiple tickers in my database, I'm subsetting where my symbol matches the ticker I pass in, and my options volume is greater than 0, and the flag is C for calls, and my strike is greater than or equal to the stock close that day. So I'm only focusing on out of the money options, and also where my days to expiration is greater than 0 but less than or equal to 7. So all those options that meet this criteria will get averaged and grouped by date. These instructions will return all the call options that meet my criteria, and the query right below will return all my out of the money puts, both grouped by day. After we return all the calls and puts, I'm going to disconnect from my database. I'm going to combine the date and the averages for the calls and the puts. I'm going to reformat the column names and convert this as an XTS object, which is the object we will return. So I'm going to go ahead and minimize this function. We'll go ahead and run it. So as a test run, I'm going to assign Google as my ticker and get the options data. We'll go ahead and take a look at our XTS object. We have a total of 382 entries, where each column represents the dollar volume for these out of the money options for both the calls and the puts. Now we're going to go ahead and plot these against the stock just so that we can get a visual. So I'll return to the script. I'll get some data for my ticker. I'm going to use chart series to plot my stock data, and as a technical indicator, I'm going to plot the dollar volumes for the calls and the puts along with the simple moving average set to 100. So I'm looking back 100 days, where I'm going to be returning a bar plot or H for my averages, and for the smooth moving average I'll be using a line, so the bars will be white and the simple moving average will be red. So let's go ahead and add both of these. Now I also wanted to add two indicators. One will be the net shares. For each trading day, I'll take the dollar volume for my calls and divide that by the stock's closing price that day, and I'll be subtracting that by the put dollar volume divided by the stock's closing price, which will give us the net direction of where people are making their bets. Since it's dollar volume, I'm dividing that by the close price to get a rough estimate on the number of shares people would have bought instead of buying the options. So we'll go ahead and assign that to net shares. Now this metric will be different for different stocks, so I'm going to add quantiles at the 99th percentile and the 1 percentile so that we can visually see the extreme points. So I'm setting my probability to 1%, and I'm going to use roll apply to get the running percentile for both the upper and lower levels. So let's go ahead and assign these. Now that we have our upper and lower levels, I can combine that with net shares and add that as an indicator to our chart. So I'll go ahead and run that line. The second indicator I wanted to add was a cumulative sum of net shares so that we can see on a running basis the changes of our net shares, and this will give us a better visual of whether people are leaning towards the short side or the long side. So we'll go ahead and add that as well. So let's take a look at that chart. Alright, so we have our stock chart along with our volume. These two subgraphs represent the average dollar volume for our calls and our puts. It looks like the last observation for the calls was an average of 44,000 versus 52,000 for the puts. And as of 10/14, it seems that we're below our 100-day moving average for both the calls and the puts, so nothing unusual. Now the following subgraph represents our net shares. Now as of this last observation, it looks like we're leaning more to the downside but nothing too significant. What I wanted to point out were these upper and lower levels. So if you notice, whenever we get spikes above or below these percentile bands, it seems that the stock price reverses. So as an example, we see this large up spike showing this large up move in the stock price, in which I assume there was a lot of demand for these call options as people thought that the stock price would continue to move up. But if we take a look at the stock price a few days later, remembering that these are short dated options, so focusing on 7 days or less, we see that we will most likely get a reversal. Not all the time, but it seems more likely than not. If we take a look at an example where our net shares were below the lower percentile band, so we'll take a look at this instance. The stock fell, created a large demand for puts, only to see that the stock reversed a few days later. So I'm going to go ahead and backtest this trading idea in the later part of the script. But lastly, our last subgraph is just the cumulative sum of net shares. So are people leaning more to the long side or the short side? Well, it looks like people are more interested in being long than short, according to the short dated options. And in this case, we can see that from our simple moving averages. So it looks like we're getting more dollar volume on the call side than the put side. And I plotted a few different tickers. So before we backtest, I'll go ahead and show you those charts. So here we have Robinhood, and I can assure you that if you maximize this plot, it'll look less crammed. I apologize for that. But again, we see these extreme points. We see that the stock has been falling, hit an all-time low, created a large demand for the puts, only to see that the stock moved up in the following days. Same thing for this large move up, created a large demand for out of the money calls. We saw a cross to the upside from our upper band, and then the stock moved lower in the upcoming days. And the sentiment down to this point, it seems that it was bearish, kind of hit an all-time low during this time period. And even though the stock has been moving sideways, it looks like people have been leaning more towards the long side than the short side. I don't know the backstory too well, but I do believe that this company has been targeted to perhaps being bought out. So maybe that's what this long bias is all about. We'll take a look at another example. All right, for ARK Invest, we have nothing but bearishness. And again, by focusing on these extreme points above and below our percentile bands, we see some sort of reversal happening within the next few days. So with that said, we'll backtest Google and see if it's profitable to buy whenever our net shares crosses our lower band, and we will sell short whenever our net shares crosses this upper band. So let's go back to our script. Alright, so for the backtest, I'm just passing in my net shares, my upper band and lower band, all combined into a single XTS object. So if we open up this function, I'm going to add the stock close to DF, and I'm going to start off by subsetting whenever our net shares crosses our lower band or upper band. Depending on the condition, we will get separate objects. So we will get buy signals whenever we cross our lower band and sell signals whenever we cross our upper band. Once we have buy and sell, I'll take a look at the return for 3 days, 5 days, and 7 days. And I'm going to use Advanced from our QuantLib to get my dates 3, 5, and 7 days after by using the NYC calendar so that I don't include holidays or weekends. And for the dates, I'm just passing in the index of buy. So price 3, 5, and 7 are going to return the stock close 3 days, 5 days, and 7 days later after we have crossed our percentile band. Once we have our stock closes, we can calculate the return by dividing the latest price over the price on where we generated the signal. And I'm going to be adding those as columns in our XTS object. The same goes for the sell signals. I'm doing the exact same, except now I'm just going to reverse the order since we're shorting. And we're going to add those as columns in our sell XTS object. Once we have the returns, since we have two separate objects, I'm just going to return those as buy and sell in my global environment. So if we minimize this function, we'll go ahead and run it. We'll go ahead and do our back test. And in our global environment, we should now have buy and sell. So we'll take a look at each. Not too many signals for the sell side. We only have 8 versus 19 in our buy side. So this first column is our net shares, our upper and lower bands, the stock close on this particular date, and then we have the return 3 days, 5 days, and 7 days later. Now let's find the column sums for these 3 columns for both of these XTS objects. So here in our script, we'll go ahead and run these last lines. And if we maximize our console, we see that the buy side generated a nice positive return for all 3 cases, even though Google has been trading lower year to date. And the returns for the sell side are substantially less than our buy signals. And I think the sell side is much lower than our buy side, because if you recall from our chart, it seems that the sentiment has been on the long side, at least for this time period, where people are more interested in buying calls than puts. Well guys, with that, this concludes the video. I'll leave a link down in the description area to my Patreon where you can find this script. If you're a Patreon member and you want me to backtest a specific ticker, just message me there and I'll provide the code. Otherwise, I'll just provide the script and the data for this example. Please subscribe to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.